Okay, perfect. Yeah, we're 5 minutes past. People will keep coming, but I guess we can start. Hi, everyone. Thank you for joining us today. We have with us Carl Wurst, who is a tenure-track faculty member at CISPA in the Information Security Group since last year, 2021. Today, he's going to be presenting us his work on Platypus, which is a centrally banked digital currency. And this work has actually been the the finalist in the Spark Innovation Award from 88 Zurich, and is currently under submission. Carl, the stage is yours. I think Carl has mentioned that he's okay with questions throughout, but we'll also have some time for questions at the end of the presentation.
Yeah, thanks a lot for the intro, Vasilis. So today I will present our design on a privacy-focused central bank digital currency that at the same time also allows a form of privacy-preserving regulation. So in the recent years, we've seen more and more central banks getting interested. There were actually every couple of weeks, there are new articles in different newspapers about what kind of or which central bank is now interested in deploying their own digital currency. And this started around 2016, where Sweden was one of the first countries who started to get interested in this kind of space. And of course, this interest is originated within or with the kind of hype around cryptocurrencies and the popularity of systems like Bitcoin and Ethereum. And central banks started thinking about deploying their own digital currencies. If we look at the situation currently, then we see that actually in most countries around the world, there's at least some interest by central banks in these CBDCs or central bank digital currencies. For most of them, this is in the research stage, and this is actually very, very broad. So this just means that there's some kind of interest where they do some economic research into this, or sometimes technical research. But this is very broad, from kind of almost proof of concept to basically just showing a little bit of interest. In some countries, there already exists some proof of concepts. And then in other countries, a small number of countries, we already have kind of trial deployment. So these pilot systems, most importantly or most famously, China, which launched their CBDC pilot during the Winter Olympics this year. And then in the Bahamas and in Nigeria, we already have a launched system for CBDCs. And what's shown here on the map are kind of, or is the status for what's called a retail CBDC. And this is different from so-called wholesale CBDCs, where wholesale CBDCs focus on a settlement layer between banks, and retail CBDCs are intended for the end user. So the idea is that you can pay with this in a shop, and that's why it's called retail CBDC. And this is also what our system focuses on. So our system is not intended as kind of settlement layer between banks, but really as something that the end user can use. Now, what is actually a CBDC, and specifically a retail CBDC? Well, if we look at the forms of payment or forms of money that we currently have in the traditional payment system, so this is excluding something like cryptocurrencies. If you look at the traditional types of monies that we currently have, we have cash on one hand, and this is something that gives us a direct claim towards the central bank. So that this cash is issued by the central bank, and this doesn't require trust in anyone other than the central bank. So as long as the central bank functions as intended, we can be sure that there's no risk associated with this cash. And then on the other hand, we have digital forms of payments, or digital forms of money actually, such as bank deposits. But then for payments, this also includes credit card payments and so on. And these rely on additional intermediaries. So there we have a commercial bank in between, where with the bank deposits, we have a legal claim against the commercial bank. So when we deposit money with a commercial bank, then we lend this money to the bank, and the bank can use this for other things as well. And the bank is only required to hold some part of that money in reserves, which means that we don't have actual direct control over the money in the central bank, but we rely on this intermediary. And this means that theoretically, if this bank goes bankrupt, then this money will be gone. Nowadays, in most countries, to prevent bank runs, we have some form of insurance for money that's held in bank accounts. But this is actually during the Great Depression in the 20s. People were worried that banks would go bankrupt, so they went to get their money out in cash, which then led to banks actually going bankrupt because the money does not provide a direct claim against the central bank. And now the idea with a CBDC is to sort of merge these together. So we want to have a digital form of money that at the same time provides a direct claim against the central bank. And this means that we sort of combine features from both of these. And there are a lot of different ways of how we could achieve this. So one of the most straightforward ways would be that we say, okay, now instead of opening an account with the commercial bank, every user can open an account with the central bank, and this would then be a form of CBDC. Now, if we generally talk about CBDCs nowadays, there's often some aspects of cryptocurrencies that people like to include, but most of this is not strictly necessary. But nevertheless, we generally want to kind of imitate features of cash as well. And one of those features is privacy, for example. The other most important being this direct access to central bank money. And if we look at what users expect from a CBDC, we actually see that privacy is one of the most important goals. So this is from a study from the European Central Bank, from a report that was released last year. And these are the top 3 goals that users listed as most important features of a CBDC. And we see that here actually privacy ranks even higher than security. So for users, it seems that privacy is even more important than this being a secure means of payment. Now there's a little bit of a caveat with this data here. So a lot of the respondents come from a technical background. So if we look at the general population, I could imagine that privacy maybe doesn't rank just as high, but it still gives an indicator that privacy should be one of the main goals from a user perspective for a CBDC. So 2 of the goals that we've already seen is this access to central bank money. This is mainly the goal from a perspective from a central bank, and the other aspect being privacy, which is important from the view of the user, but not just of a user, but also in terms of kind of large-scale data privacy. If there is no data, no actual data to be seen by if you, for example, have a leak of some information, then there's less risk of kind of large scale privacy loss, which is also interesting actually for the central bank keeping track of this. And this is also something where a lot of central banks, at least in like the European Central Bank, but also the Swiss National Bank, they actually explicitly want to allow for some form of privacy because they don't want this to turn into, or to be able to turn into, a tool for mass surveillance. So this is something that should be integrated in such a CBDC design. At the same time, we don't want to allow kind of full anonymity, because if you imagine this being issued in a country, this is kind of an official currency, then it's generally in the interest of the public to be able to prevent or detect illegal activity, such as money laundering, tax evasion, or similar things. So we want to be able to allow for some form of regulation. And last but not least, the system should, of course, also be efficient, because we want this to be able to scale to the transaction volume that we might have in a country or an economic area like the EU. So this should be something that's scalable, that has kind of low impact on the client. So for example, we don't want clients to have to download gigabytes of data to partake in this. They should just need to keep track of some small state. And it shouldn't take minutes or hours for transactions to confirm. Now, one solution that's often proposed, because cryptocurrencies are one of the motivators to even think about this, is, of course, a blockchain. And in a blockchain, we have this network of validators in a peer-to-peer network. This can be participants in proof of work in something like Bitcoin, or this can be a permission system where we have a fixed set of validators that run a traditional BFT consensus protocol between them. And they keep track of the transactions in a ordered list, generally called blockchain or distributed ledger. And if Alice wants to pay Bob some money, then she would send her transaction to this network. There it gets included in a block and added to the blockchain. And Bob can later retrieve the transaction or all of the information in the blockchain from one of the nodes in the peer-to-peer network and see that he received a transaction. And there are advantages to this design, but there are also disadvantages, especially if we want to use it for a CBDC. One of the advantages, or actually two advantages, is that it's robust and transparent. So robust here means that if we have a network of validators and some of them get compromised, then the system as a whole will still remain secure. And transparent here means that everyone can verify that whatever happens in the system was done correctly. So everyone can verify that the transactions are valid, for example. However, one of the disadvantages is that privacy in these kind of systems is generally hard to achieve. So there are ways to achieve actually very strong privacy guarantees. So the state of the art here is the transaction style of Zcash, basically, where you have a anonymity set that includes all previous transactions, and where the verifier of this transaction essentially doesn't see anything about the transaction. But this comes with drawbacks in these kind of systems, because it requires some significant computation. But this has improved a lot actually in the last few years. So Zcash transaction creation is now possible in the order of seconds. It used to take minutes to create a transaction. But actually, the much larger issue is how the information is provided to the clients. So in order to make use of the privacy guarantees that you get with something like Zcash, or also other systems like Monero, the recipient has to basically download all transactions that are listed in the blockchain to see which one he's a recipient of. And they need to perform a trial decryption for each of them. And this means that we have actually quite a heavy load on clients. There are protocols that reduce this load. For example, you can use some trust execution environments, but then that relies on trust in these trust execution environments. There are also protocols relying on private information retrieval, but these then impose very heavy or a very heavy load on servers. And this will be prohibitively expensive if we consider having a transaction throughput that we would expect in a CBDC. And so we sort of have this trade-off of either providing a server with a key that allows them to see our transactions and filter them for us, or we need to download all of the transactions. And this is one thing that we want to basically get rid of. Another thing in these blockchain systems is that they're quite difficult to scale. So this is much easier in permission systems that would likely be used for a CBDC than in permissionless systems like Bitcoin, but still they are harder to scale than database systems. And then last but not least, and this is the main reason why it makes sense to look at different solutions other than blockchain for a CBDC, is that we have an inherently different trust model in a CBDC. So if we have a CBDC, we have a central bank that is by default trusted for the integrity of the money. So we can also trust this party to ensure that we don't have double spending and to perform the issuance in this digital version as well. So one thing we actually want to do is we want to partially trust the central bank, namely we want to trust it for integrity, which is inherent, but we don't want to trust it for privacy. So we want to protect the privacy of the transactions even against this trusted party, so that the trusted party, the central bank, is only trusted for the integrity. And in this setting, there's actually, there has been this kind of technology around for a long time. So this is more or less the setting that was considered in eCash by David Chaum, where we have a bank and we have users, and this bank is trusted for integrity. And in eCash, this bank basically has, or the users have accounts with this bank. So in this example, Alice has 5 coins and Bob has 6 coins. And then they can withdraw a digital version of this. So this is similar to going to an ATM. You would withdraw some money into this digital cash. And so if Alice wants to withdraw 1 coin, she creates a random serial number that will be unique to this coin because it's a large random number. And then she blinds that serial number by basically randomizing it, sends this to the bank. The bank then subtracts 1 coin from her balance and signs this blinded value. And the signature scheme used here is what's called the blind signature, which means that this is homomorphic, such that when Alice receives this back, she can remove the blinding and receive a signature on the actual serial number. And this signed serial number is now 1 coin. And this is not linkable to Alice because there's, through this blinding and unblinding, the central bank or the bank does not know what value belongs to Alice. So when she sends this to Bob, then Bob can deposit this at the bank. So Bob, in this case, is a merchant selling some goods to Alice. Bob deposits this at the bank. The bank checks that the serial number has never been used before. This is used to prevent double spending so that Alice cannot reuse the same coin over and over. And it checks that the signature is correct. And if that's the case, then it credits Bob's account with 1 coin and tells Bob that the transaction was successful. So Bob can accept the payment and give Alice the goods in return. And the goal of this system was to specifically provide privacy. And it seems like if we have this kind of system, then what more do we need? But again, as almost everything, this has advantages and limitations. One of the advantages is that it's highly scalable. So in this case, we basically can use standard database scaling techniques. The one thing that we need to make sure of for the integrity of the system is that serial numbers cannot be reused. And of course that the signing key is not compromised. But basically, in terms of consistency, we need to check that no serial number is used more than once. And it offers privacy for the sender. So when Alice performs a payment to Bob. There's no way for the central bank to link this payment to Alice. So we have anonymity for Alice in this case. It also allows for regulation. We can regulate this at the withdrawing side or also on the depositing side. So the bank will see exactly how much money withdraws. And the bank also sees how much money Bob deposits. And generally, if we have an online eCash system, the bank will see how much Bob deposits for each transaction. So this can be taken into account for reporting duties for large transactions, for example. However, we don't have any privacy for the recipient. So when Bob deposits funds, this has to go into his account. So the bank sees that Bob now received a transaction. We also, for at least for online systems, we don't have any privacy for the value. So if Bob receives 5 coins from Alice and he deposits these 5 coins, then the bank sees Bob now received 5 coins in one transaction. There are offline eCash schemes where Bob would later deposit the money, but there are other trade-offs there. So there you don't have double spending prevention, only detection, and still the overall volume that Bob receives leaks to the bank. And then lastly, the transaction size and the computation for the deposit depend on the value. So with the original eCash, the transaction size is actually linear in the transaction value. There are now more efficient schemes. So there's divisible eCash, where this transaction size is just linear. But for the computation, you still need to verify each individual coin. So this is, of course, not ideal. So the goal of our system is basically to keep the advantages of eCash, but remove the limitations. Most importantly, we want to achieve privacy for all parties, and we want to have the value hidden. And in our system, so our system is called Platypus. This is because similar to how the animal combines features from different animals, we combine ideas from eCash with ideas that originated in the cryptocurrency space with an account-based management system that we have with bank accounts, basically. And in our system, similar to eCash, we have the bank and we have users, but the bank doesn't keep track of any accounts of the users. Instead, the users keep track of their accounts themselves. So in this case, we have every user stores their current state, their current account state. And this state basically consists of their current account balance. So Alice, in this case, has 243 Swiss francs and a pseudo-random serial number. And so this serial number will be unique to this current account state. And in addition, the users have a cryptographic commitment to this information that has a signature from the central bank, which is the result of a previous transaction. So we assume here that both Alice and Bob have been part of the system already, so they have performed some transactions. So they have this signature on this commitment from some previous transaction, and they store this locally. So Bob has the same information for his account. And now, and now when Alice wants to send some money to Bob, so for example, she wants to send him 50 francs, she first locally updates her account. So she creates, or she updates her account balance. So she subtracts the value that she wants to send to Bob, and she creates a new pseudo-random serial number. Then she creates a commitment to this. And she also creates a commitment to the transaction value. Then she creates a zero knowledge proof that proves in zero knowledge that she did all of this correctly. And also adds this to the information that she will later send to Bob. And she also reveals her old serial number. So this is the serial number of her previous account state. And the zero knowledge proof shows that all of this information was computed correctly. Then she sends this to Bob together with the transaction value, as well as the randomness that she used to create the transaction commitment. So the gray envelope here. This allows Bob to reuse the same commitment to prove things about this commitment as well. And Bob uses this commitment and basically performs the same steps as Alice, with the difference, of course, that his balance increased by 50 francs instead of decreased. So he does the same thing, creates a commitment for his new account state, reveals his old serial number, and then we have this set of 3 commitments. So we have the commitment to Alice's new account state, to Bob's new account state, and to the transaction value. Then we have a zero knowledge proof that proves that Alice did everything correctly, and a zero knowledge proof that proves that Bob did everything correctly, and the serial number of both of their old account states. And then Bob sends this to the central bank. The central bank checks that the zero knowledge proofs are correct, so that they verify, and that neither of these serial numbers have been seen before. So this is similar to eCash. There we also use a serial number to prevent double spending, and this is the same thing here. So we check this such that neither Alice nor Bob can reuse old account information. If that's the case, then the bank knows that this transaction is valid. It signs the new account state commitments and sends them back to Bob, who forwards the commitment or the signature for Alice's commitment to Alice. And then at this point, they can basically forget about their old account information, and we're at kind of the beginning, and they can now interact with other parties again. And so in this case, there's no point in which the bank sees the transaction value or anything other than these commitments and the zero knowledge proofs and the pseudo-random serial numbers. So this provides actually, or this hides all of this information from the central bank. Now I mentioned that we also want to allow for some forms of regulation. And this seems that now we have this system where we basically have full anonymity. So how do we add regulation to this? So the first thing that we need to do is have some form of identities. And we actually add a party into the system that we call the regulator that is responsible for establishing identities and for checking information that is reported to them. So basically for everything that covers regulation, we have this party called the regulator. In practice, this could be split into multiple parties. So we could have some party that establishes identities, some other party that is responsible for enforcing one compliance rule, and then a third party that is responsible for enforcing another compliance rule. But for simplicity, we just have one party now here in our system. And so, sorry. So when Bob wants to sorry. So when Bob wants to enroll in the system, he first needs to establish an identity. And this is important for any kind of regulation that we want to enforce, because if we just allow participation that is pseudonymous or completely anonymous, then a user could just create 1,000 identities or 1,000 accounts and then circumvent almost any kind of regulation that we could enact. So the first step here is Bob basically going to this authority or performing an online KYC process or something like this, and proving his identity to this authority, and in return getting back a certificate that certifies that he is Bob. So basically a signed letter by the regulator stating that, that he is Bob. And now once we have this, when Bob wants to create his part of the transaction, we have here all these other values that we also used in previous example in this base transaction. So when Bob now wants to create the zero knowledge proof, we can add a condition to the zero knowledge proof that says Bob needs to prove that he has a certificate. And by doing this, he then gets zero knowledge proof. He can send this as part of the transaction to the bank. And then we don't add any additional information. So in this case, it really just shows that he has an identity. This doesn't give us much yet, but it's kind of one of the necessities that we have for any kind of rule that we then want to enforce. So now we have this kind of proof of identity. And one form of regulation that we can now enforce very easily is what we call a hard limit. So this, for example, means that we want to prove in the zero knowledge proof that the account balance is less than a certain value. So in this example, we say, in order to perform a transaction, Bob needs to prove that his new account balance is less than 1,000 francs. And so in this zero knowledge proof, Bob proves that he has an identity and that his new account balance is less than 1,000 francs. So the proof succeeds, and then everything else works as in the base transaction. Now, if we change this a little bit and say Bob received 100 francs in the transaction instead of 50, now his new account balance is more than 1,000 francs. Then in this case, because we have this condition in the zero knowledge proof that his balance needs to be less than 1,000, the zero knowledge proof will fail, so he will not be able to perform the transaction. This is very simple to include once we have identities, but it's probably not what we want in most cases. So usually we don't want to prevent users from having transactions. We just want to make sure that if they have some transaction that hits some limits or meets some other restrictions, then they should disclose some information to an authority, in this case, the regulator. And this is something that we can also do in our system with what we call soft limits. So in this case, we now look at the same scenario where Bob received 100 francs. So his new balance is more than 1,000 francs. But in this case, we don't want to enforce a hard limit, but we just want to force him to disclose information if he exceeds the limit. So to do this, we basically want him to give this information that Bob now has 1,042 francs. This piece of information should go to the regulator. And the simple way, or the way that we can do this, is that we encrypt this information with the public key of the regulator. And then in the zero knowledge proof, we prove that if Bob exceeds this limit, then he encrypted his identity and his balance with the public key of the regulator. And then this piece of information is sent along. So this also included, of course, in the zero knowledge proof. He proves that this was done correctly. And then this piece of encrypted information is sent along with the transaction to the central bank, which then forwards it to the regulator. The regulator can decrypt it and follow up on this. For example, check that Bob correctly reported this in his tax forms. Now, the question here is, what do we do now if Bob is compliant with this rule? So what if Bob has less than 1,000 in his account? So we go back to the example where he received 50 francs. And now we could say, well, in this case, he doesn't need to provide any encrypted information. So we can just do the same as with the hard limit for 1,000 francs. However, if we do this, then we actually lose some privacy, because in that case, any observer of the transaction could distinguish the two cases where Bob has more than 1,000 francs or less than 1,000 francs. So instead, we actually let Bob encrypt some dummy information. So basically an empty piece of paper He encrypts this with the public key of the regulator, and then proves that he has less than 1,000 in his account, and he correctly encrypted this dummy information. This is also sent along with the transaction. The regulator decrypts this, sees that this is some dummy information. So this dummy information is globally defined, so distinguishable from real information. And so the regulator can basically then throw this away and knows that the transaction is compliant with the rules that we want to enforce. But for any observer, the transaction looks exactly the same, no matter if Bob has a balance of more or less than 1,000 francs. Now, we might want to do actually even more than these kinds of limits. We might want to prove something that requires additional state information. So we might want to prove some stateful information. And I'll give you an example here. So one rule that many countries have is that if you receive a large cash transaction, then you need to report this to some authorities. So in the US, for example, if you receive more than 10,000 US dollars, you need to report this to the IRS. But if you want to enforce such a rule in this digital space, then this can again easily be circumvented, because if you just say, well, in one transaction, we cannot have more than a certain amount, then you can just create multiple transactions and nobody will see that you're circumventing this limit. So we want to keep track of how much money you have received within a certain time interval to make sure that this cannot be circumvented. So for example, you want to say every user can receive up to 1K anonymously per week. And we can do this by storing the weekly running total as well as some week identifier, or this doesn't have to be a week, this can be any kind of epoch in the account state, so in the information that we commit to with these commitments. And then we can prove things about these running totals as well. So we prove that the running total is less than the limit. And this kind of stateful regulation is enabled by this account model that we have, which simplifies these kind of things if we compare this to using a UTXO model that is common in a lot of blockchains. So I quickly want to talk very quickly about privacy. So I've always shown these colored envelopes, but of course that is not something that any observer sees, though. So you cannot match the colored green to Bob. Instead, these are completely opaque. So any observer will basically not be able to distinguish commitments of one transaction and the commitments of another transaction. So the only thing that you see in clear text are these pseudorandom serial numbers, but these are pseudorandom and unique per state output. So you have 2 per transaction. And so we actually get full transaction unlinkability, similar to what we have in Zcash. And these properties are preserved with regulation. So to a third-party observer or to the central bank, this is unconditional. And as long as the transactions are compliant with the rules, this also holds against the regulator. Of course, if you exceed the rules and have to report information to the regulator, this is available to the regulator. Lastly, I want to quickly mention the performance. So in our system, the clients only need to store a very small state, which is very nice because they don't need to download transactions from a blockchain or something like this. The proving time is actually very fast or reasonably fast compared to a lot of other systems. So this is on a desktop computer. We can prove the base transaction in our implementation in about 1/10 of a second. And with these kind of limits, so these are both soft limits. One is the holding limit that I've shown before, and one is the receiving limit, where we limit the receiving per amount of time. And both limits means we have both limits for the transactions. And these are also less than half a second. So this needs to be performed both at the sender and the recipient. We also tested this on an iPhone to see how this performs in a mobile setting. And even then, these proving times are less than a second, which means that this is usable for retail payments. And the verification of these transactions or of these proofs is extremely fast. So this is constant, independent of the type of transaction that we have, with an implementation based on ZK snarks. So this is less than a millisecond per transaction. And we also implemented a kind of proof of concept end-to-end system to benchmark throughput. And for this, we achieved 922 transactions per second on a single server. So this is actually an old desktop computer from 2017, I think, with an i7 quad-core processor and 16 gigabytes of RAM. So this is actually quite a lot. This would already be enough to support the transaction volume of a lot of small countries, including Switzerland, for example. And this scales very easily because we can use similar techniques as for eCash, where we basically scale based on standard database sharding techniques. So we can easily scale this up to thousands of transactions per second by adding more servers and database backends. So to summarize this, a lot of banks or central banks in the world are interested in deploying central bank digital currencies, and with the goal of having kind of a digital cash equivalent. With our system, we achieve this. We achieve very strong privacy properties and have an efficient system in this kind of centralized setting where we trust the central bank for integrity. So we have full unlinkability for the transactions and privacy properties that are comparable to what we have in Zcash, for example. And we also enable privacy preserving regulation that in most cases, so as long as you're compliant with some regulation rules, will not leak any information to anyone. And in cases where you're not compliant with some rules, will just force you to reveal information to the designated regulator, but otherwise fully protects your privacy. With that, I'm at the end of my talk, and I'm now happy to take questions.
Okay, yeah, thanks a lot. Let me stop the recording and the live stream, and then we can go over to the Q&A session.